My name is Jake, welcome to the channel, and today's video we're going to do another Review My Pie video where I review subscriber portfolios. So you're probably wondering, what the heck am I looking at? You're looking at a Lufthansa airplane here. So today is July 4th, happy Merca Day everybody. My wife and I were actually traveling this week to Germany to visit her family up in northern Germany, up in Kiel. We're going to be going down to Munich where I used to live, over to Cologne, all that fun stuff. So if you're new to the channel, I used to live in Germany for about 10 years. And yeah, my wife and I, we moved back to the States about 5 years ago. And yeah, so we're planning actually in early retirement to make it back to Germany for about a year or so. We love the healthcare system over there. It's much more affordable. Inflation is pretty high over there as well, but just the overall standard of living on a budget, in my opinion, is a little bit higher in Germany, mostly due to the healthcare costs that come with that. So, but yeah, I'll share more about that later. But yeah, we're going to be traveling for about 2 weeks. And I thought to myself, do I want to go 2 weeks without creating a YouTube video? And I thought, you know what? Hey, I'm just going to pre-record the videos. I'll, release them while I'm out there on my regular schedule, and I'll respond, here while I'm in Germany. So when you're watching this video, I will either be in Kiel or in Munich. I'm not 100% sure exactly where we're going to be at, but yeah, so that's where we're at there. In today's video, we're going to do a Review My Pie video like normal. What we're going to do is we're going to answer a subscriber question, and then we're going to review 3 portfolios here. So the first portfolio is going to be from a 28-year-old from Israel. And if you're not sure with where Israel is, it's here in the Middle East between Egypt, Lebanon, Syria, Turkey, right here. So I think most people probably know where Israel is. But yeah, the second portfolio is going to be from a 22-year-old here in the United States. The third portfolio, a 36-year-old here in the US. And there's a lot of 20-year-olds and 30-year-olds. I know that there's a lot of 40 and 50 and 60-year-olds that follow the channel. I don't get a lot of submissions here for the Review My Pie for 40, 50, and 60-year-olds. So if you're watching this video and you would like to submit your portfolio, go ahead and do so. There's an email in the description below. I love to see it where people from international, submitting their portfolio, so that we don't just have only US portfolios that we're reviewing. I know that there's about 40% of the audience here on YouTube that watches and follows my channel are actually not from the US. So if you're outside of the US and you're, over the age of 40, well, anybody can submit their portfolio, obviously, but definitely if you're 40, 50, or 60 right now, because I don't have as many, I would like to spread out the age group so it's not just all 20-year-olds, just to have a little bit more diverse in terms of the demographic and the audience here. Yeah, I try to do it first come, first serve. But yeah, so as always, the timestamps are in the description below, as well as the portfolio links will be in the description below. And as always, everybody, I'm not a financial advisor. This is just merely for your entertainment and all that good stuff. So, and as always, I don't pre-record, pre-review the portfolios. I'm reviewing them for the very first time. I want to make it as authentic as possible. So as I mentioned, we're going to be traveling here to Germany this week, and I'm a little bit antsy because we've never taken our little baby boy, baby Lucas, who is a little over, I think he's like, what, 14 months now? 14 months. We've never taken him in an airplane. So I'm a little bit scared and concerned about how that's going to go. We're going to be that family with the screaming baby, I'm sure. And traveling, when I was growing up, I'd always hate sitting behind or next to a crying baby. So I guess I'm going to be that guy this time. But yeah, so I don't know what it's going to look like. We'll see how it goes. But yeah, traveling with a baby or with baby Lucas for the very first time in an airplane, it's probably going to look a little like this. Oh my gosh, when I saw that, I was cracking up. Janice, I'm stuck. That is actually probably what baby Lucas is going to look like, because we do have a little pouch that my wife is going to carry him in. So yeah, that's going to be actual footage there. I'll try to remember to take pictures and maybe I'll share them in when we get back here. All right, so the first question here is from Sakib. He writes here, hey Jake, first of all, thank you for your time and effort you put into making your YouTube videos. My name is Sakib, and I've been watching them and finding them inspiring and interesting. Well, thank you so much. I appreciate it, man. You and your wife's vision and execution on your path to fire is what I aspire to emulate. But my problem is, although I watch yours and other similar videos on a routine basis for the past year, I am still struggling to structure my path towards fire. I'm a dentist in New Jersey, and my wife works in as a healthcare admin. I've been practicing for almost 4 years in my office where I'm a doctor. I do not own the practice. Last year, I started looking into practices to buy when I realized I did not want to be tied down to a practice and a location for a foreseeable future. The truth is, I do not love my career. I do not hate it, but I look at it as purely as a means to earn good money, which I invested properly. Can help me, my wife achieve fire in the next 8 to 10 years. Currently, I'm 31 years old. This is absolutely incredible, man. This is really relatable because I'm in a very, very similar situation as you. So really interesting. All right, so I take home approximately $400K a year. Well, not quite as similar. You're a little bit higher than me. And my wife earns about $65K a year, bringing our household income to $465,000 a year pre-tax. I do not have any debt. I currently rent an apartment, but I'm in the market to buy our first house, which will be approximately $600,000. I have almost $80K in my Roth IRA and $150K in my taxable brokerage account, all invested in a multitude of stocks and ETFs, including VOO, so the S&P 500, SCHD, this is my favorite dividend ETF, the Dividend Kings, NKLA, NEO, McDonald's, Apple, and others. Overall, there is no real guidance to my portfolio and is definitely not ideal with some stocks and ETFs at major losses. Okay, well, you're not alone there. My question is, where should I go from here? I do not have time from 9 to 6 to do anything stock related Monday through Friday. Most of the time, due to how busy I am at work, I want to sell most of my holdings and focus on VOO, SEHD, and other growth ETFs and a few stocks. What would be your recommendation for a basket of a few dividend growth ETFs and stocks to focus on? Thank you so much. Well, hey, Saqib, this is such an amazing email. The thing that I love about this is you are in a unique situation where you're at that point in your life where you're at peak earning potential. 30 to 40 to 50, that's where you're reaching peak earning potential. For the last 10 or so years, you probably have been studying, working maybe at a grocery store, right? Put yourself through college, right? You made it. You made it to your career. Now you're making a ton of money. Now, the money is all relative. It may be that, that $600,000 house, you have high property taxes. You mentioned that you don't have very much debt or no debt, which is great. The thing here is when you're in such a high tax bracket with you and your wife, the best thing that you can do is put together a plan. Well, first off, I want to say there's a lot of paths that you could take. And I think where you're struggling, and I struggle with the exact same thing, is I try to over-engineer things and try to find the only path, the best and only path. And I realized years later that there's no one-way path. There's no one path. If you really want the one and only path, just invest in the S&P 500, max out your retirement accounts and call it good. But the thing is, by doing that, you're focusing solely on your retirement accounts, and it kind of restricts your timeline because you can access those accounts at 59 and a half. Okay, so that's the very first thing that I would say. First off, you want to make sure that you're maximizing your tax efficiency. You're maximizing your Roth IRA. Hopefully you have an HSA. If your employer matches up to the employer match at least, you are one of those that are a really high earner. So if there's a way that you can reduce your taxes, that is probably the most important thing that you could do right now. You have first world problems. You're a high earner, but the thing that I like what you mentioned here is you don't want to be tied down to a practice. If you commit and you buy something, a practice, you're going to be tied down for quite a while. And that doesn't sound like that's something that you want to do. It sounds like you want more flexibility in your life. When it comes to your investments, the Nikola, the NEO, the McDonald's, the Apple, here's the thing. You can, in my opinion, you can invest into those speculative companies, but limit the exposure. Try not to have your speculative investments make up more than 20% of your overall portfolio. As long as it's less than 20%, I think you're okay. And I still like the rule of thumb here is to not have more than 5% in a single stock. That way you're reducing your overall risk. Okay, so regardless of how high of a quality the company is, making sure that you're not investing in more than 5% into one individual stock. I love SEHD, I love VOO, and you mentioned you want to put this, on autopilot. I think just dollar cost averaging into VOO and SCHD, I don't think you can really go wrong. The sooner that you can identify your time horizon, that's the best thing that you can do. Because once you have your time horizon, for example, hey, you're 31 years old, you want to retire at 37 or 40, then what you can do is then you can reverse engineer it and you can say, okay, I have an 8-year time horizon. I'm contributing 70% of my take-home income into my portfolio. That's growing at 7-8% compounded over that time period. How much money do I need, and how much am I going to be getting in dividend income? And so if you have your end goal in mind, you can then reverse engineer it and plan accordingly. But the tricky thing is, what makes this so difficult is unless you have that time horizon in mind, unless you know approximately when you want to dial back and live off of the dividend income, it makes it very difficult. But I love that you're focusing on high quality ETFs. I really like VOO. I really like SCHD. If you honestly wanted to do like 50% VOO and I don't know, 30% SCHD and then 20% something else, I don't see anything really wrong with that. I think most people would probably benefit from that. So that's the thing, I love following the FIRE movement. For those of you that know J.L. Collin, I love his book, The Simple Path to Wealth, right? He just recommends investing in a VTI or VTSAX, right? The total US stock market, and call it a day, right? Now, this is a little bit different with dividend investing because you're planning on living off the dividend and not selling your individual shares. So there's a little bit of a difference there. What I would encourage you to do is as you learn more about your goal and your investing strategy and time horizon, then you can make educated decisions on how you build your portfolio. But the key thing for you that I would recommend, and for everyone in your situation as a high earner, is optimize on your tax efficiency. That's the first thing that I would do. Okay, well, hey, Sakib, I hope that was helpful. Thank you so much for the question. All right, let's take a look at the first portfolio here is from Andrew. He writes, hey man, I've been a subscriber and following your channel for a while. Great stuff. Truth is I just started to invest in dividends long-term. Currently, I'm 28 and look for a lifetime investment in dividends. I'd like to know your opinion about my portfolio, but the thing is I live in Israel and have no access to M1, unfortunately. That's fine. But I do invest through a local company. I use a dividend tracker site. Would like at least to know your opinion if possible. Thank you. P.S. There's no reinvesting option, sadly. Only put money, buy more. By the way, I do dollar cost average. Okay, so it doesn't look like you can't. There's no drip. Okay, that's unfortunate, but it is what it is. My portfolio, it just makes it a little bit more manual. It's not a big deal. My portfolio is built from 34 stocks and 4 ETFs. Okay, I like it. Okay, well, cool. Let's take a look at your portfolio here. So let's see here. Let's see, maybe we can zoom in. There we go. All right. So the difficult thing here, Andrew, I can't really, the difficult thing is I don't know your time horizon. Yeah, you're 28 years old. If you're looking to live off the dividends at 50 or 60, it's very different than living off your dividends at 35, right? And so I can't really give you some context there. All I can do is make assumptions because you didn't put it in your email. What I'll do is I'll just focus kind of on, the companies at hand, right? So are they good companies, in my opinion, et cetera, et cetera. All right. And when I mean good companies, let me define that. A good company for me is, dividend history, dividend payout ratio, industry, competitive moats, like all that fun stuff that comes with it. And because I'm a dividend nerd and I do this pretty much like every week, like all the time, I have a good understanding of a lot of these companies. In fact, I know every single one of these companies. So AbbVie, yeah, I like AbbVie. It's one of my holdings in my portfolio. Abbott is another good one. It's a spinoff of AbbVie. Pretty good. Let me look at this one here. BDX, I do really like BDX. BDX is better. It's a healthcare REIT. It's, healthcare company. I just talked about REITs in another video here. BDX is a healthcare company, and it's a really, really high growth company. Ben is a financial investment company here, but it's a dividend aristocrat, but it's not growing as fast as, I like T Rowe a little bit better, for example, but it does have a higher dividend, but it's not growing its dividend as fast as T Rowe. Cincinnati Financial, I think this is a dividend king, if I'm not mistaken. Yeah, it's good. Yeah, I mean, it's not my favorite, but it's not bad. I mean, it has a great history. Colgate the thing that I love about Colgate is that quote from Warren Buffett in that he loves Colgate because of the psychology of men. Men don't like to change. Men are not as, they don't change things as often or frequent as women. And when was the last time that you changed your razor blade or your toothpaste, right? So I always love that quote from Warren Buffett. Yeah, I do like Colgate, but it's not growing as fast as a few other staples out there. All right, let's take a look at your next one here. What do you got? You got Dover. Dover's another good one. Emerson Electric. You got some Dividend Kings in here. FRT, really good. These are all really like Dividend Kings and Dividend Aristocrats, Genuine Parts, Granger, Hormel, IBM, Johnson & Johnson, Kimberly-Clark, Coca-Cola, Leggett. Do you have these all equally weighted? Where's the weighting? Let me see if we can go back. Where's the weighting? Yield and cost. Where's the weighting? Equity. I'm trying to see if I can see the weighting in your portfolio because I don't know if you want to have them all equally weighted. Maybe you do. McDonald's, 3M. Like this is pretty much like just Dividend Aristocrats. Go and Google Dividend Aristocrats, and this is what you're going to get. PPG, I really like this one. Really good industrial company. It's an alternative to Sherwin-Williams. SEHD, really, really great ETF. Stanley Black & Decker, Cisco. Yeah, these are, you pretty much what you did, which is not a bad thing. You went and you Google the Dividend Aristocrats and the Dividend Kings, and then you just added them all to your portfolio. That's not really a bad thing, but I think that's a good starting point. But what you'll notice is in order to follow up on this portfolio, you're not going to need as much time because these are all really well-established blue chip companies. The question is do you need them all? Right? With SEHD or with VYM, you're going to get a lot of these companies already in these ETFs. All right, so what I would do, I like this, but I also think it's maybe a little bit, you could maybe make it a little bit easier. So this is what I would recommend, and this goes for everyone. I would take a look. I love all of your ETFs. I think your ETFs are great. What I would recommend you do is take your ETFs, make those maybe your highest positions in your portfolio, and then pick 10 to 20 of these other individual companies, and then consolidate. I don't think you need all of these, right? Like you got T. Rowe in here, you got Ben, and you got Cincinnati Financial. I don't think you necessarily need all of them. And so the question is what I would recommend is pick your favorites, right? And then just consolidate there. But if you don't want to do that, I think going broadly and over diversifying is probably a better thing. Oddly enough. Okay. So those are the two things. If you don't want to focus heavier on ETFs, then I think going wide with a couple of, having more companies in there is probably better because you don't know what the future is going to hold. And I love that quote from Warren Buffett. If you really truly don't know what you're doing or which company is the right company, Warren Buffett actually recommends to over diversify. And he actually, recommends that more so with ETFs. But that's my opinion there. I think I can see value in this, but I don't quite think it's fully necessary. So I personally would consolidate it a little bit. But yeah, Andrew, thank you so much for sending over your portfolio, and shout out to Israel here from Texas. All right, the second portfolio is from Diana. Awesome. We got a female viewer here. I think there's like 5 or 6%. I don't know if Google Analytics is correct, but I think like 6% of my audience is female. So way to represent, Diana. Thanks for sending over your portfolio here. All right. So hi, Jake. Hope all is well. My name is Diana, and ever since I found your channel, I've spent all of my time watching and rewatching some of your videos, trying to implement the knowledge you provide. I'm 22 years old, and I started investing a few weeks ago for the long term. My time horizon is 20 years, and I've opened up an IRA and a standard brokerage account. Based on your videos, I've decided on 2 different strategies for the accounts. My IRA is focused more on growth, and the standard is more on generating cash flow. I plan to dollar cost average for both accounts and to reinvest the dividends. I would love and appreciate any feedback and you would have for me regarding everything. LOL. Thank you so much for the work you put in and wish you all the best. P.S. How important is sector allocation diversification within each account? Or should you look at it from your accounts altogether, as well as taking a look at both accounts? While my approach is different for each one, should I focus on how they complement each other? If so, how? Well, Diana, thank you so much for the email. I really appreciate it, and I think you're in a really good spot here. So here's the thing: the questions that you're asking in this email I was asking myself at like 31. So you're 10 years ahead of me. I think that's absolutely incredible. So everybody that's watching this video, if you're asking yourself a similar question as Diana here, and you're in your 20s, you're already winning at life, right? You're already ahead of the game. Okay, so when it comes to the account diversification, really quick, my guidelines for success when it comes to this, no more than 5% in one single company and no more than 20 or 25% in a single sector. Okay, that's how I set up my portfolio. And because I invest so heavily in ETFs, I get the instant, diversification anyways. That's why I love ETFs. Okay, so with ETF, when you're investing into ETFs, sector allocation is not quite as important unless you're investing into individual sector ETFs. All right, let's take a look at your Roth IRA. So your Roth IRA is generating 73% over the last 5 years. You got a low, decent dividend yield. I think are you beating the S&P 500? Are you beating the S&P 500? I think you are. Okay, let's see here. So you got VTI, really like VTI. I really like VGT, DGRO. I like DGRO, SPYG, VXUS, and VNQ. I actually really, really like this. This is very similar to my Vanguard Roth account. So my largest holdings, actually, this is almost identical. The only difference is I don't have DGRO and I don't have SPYG in my personal Roth IRA account. I have them in my taxable account. But I have VTI, VGT, VXUS, and VNQ. Those 4 ETFs I own in my Roth IRA. My largest, I think I have 40% in VGT and 40 in VTI, and then 10 in these two, in the international and real estate. So yeah, I actually really like this. The reason why I like it is it's focused on growth, but it's a conservative growth, right? You're not investing into companies that may go bankrupt in 10 years. Right? You're investing into ETFs that are self-cleansing, that are market cap weighted. That means that if one company does well, it goes up in your weighting in the ETF. And if a company does poorly, it goes down in the allocation in your ETF. And guess what? It's 100% passive for you. I really, really like this ETF. And I personally believe, this is my opinion, I believe anyone and everyone could take a similar approach, keep it super simple, focus on quality. You could do 100% VOO. You could do 100% VTI. I do personally like having a little bit more skewed towards growth, especially because you're in your early 20s. Let's do some math. I was never, horribly good at math. Let's do 59 times 22. You have 37 years. 37 years for this portfolio to compound and to grow. Yeah, I like that you're focused more on the growth here, and I like it. I like it a lot. Standard portfolio, this is your taxable account. What do you got in here? You have a higher dividend. Okay, 26 holdings, and you have a 20-year time horizon. Okay, I can live with this. The reason why is I'm looking for tax efficiency, right? When you have a 2.5% dividend yield, you're going to be paying on that dividend in taxes for the next 20 years, right? So you want to make sure that you're optimizing this for tax efficiency. All right, so what do you got in here? Dividend ETFs, consumers, ETFs, industrials, healthcare, consumers, utilities. Okay, so no REITs, no energy. Okay. Dividends, DGRO, SEHD, VYM. I like it. I think, would I change anything? I probably would not change anything. And I invest into all 3 of these, so I'm obviously not going to say anything bad. So maybe I'm biased, but I invest into these because they're really damn good. They're really good ETFs. They're like, I'm a pretty big dividend nerd. These are some of the best dividend ETFs for your average person. So I really, really like them. Staples, what do you got in here? You got Walmart, Pepsi, Procter & Gamble, Costco, Coca-Cola, Altria, Philip, and Schmucker. I like it. Let me look at the allocation here. You could lower Coca-Cola. Lower Coca-Cola and Procter & Gamble. Definitely consider it. The reason why is 20 years. Bring up, maybe this is I'm just spitballing here, just a few thoughts. 20%, 20%, 20%, and then equal weight the others. is how I would do it personally. You said 20-year time horizon. 20 years is a long time. You don't need Coca-Cola at 15. You don't need Procter & Gamble at 16. What you want is you want a company like Costco and Pepsi growing at double digits. That's what you want. And when I say growing, I'm not just talking about capital. I'm talking about dividend as well. So you got more ETFs in here? What do you got in here? VOO and VEA? Yeah. Yeah, sure. Why not? Go for it. Yeah. Here's the thing. I would say 80% of those of you listening to my voice right now, this should be your highest slice in your portfolio. This right here. For 80% of people watching my channel, once again, I skew my content towards new investors. This should be your highest portfolio, like your highest slice in most cases. Unless you're a dividend nerd like me and you spend countless hours a week, researching dividend stocks on Seeking Alpha, watching YouTube content. I'm a nerd, right? You're probably not like me. So therefore, you should probably be doing something a little bit different. And that's why I think most people should have this at their highest allocation. Industrials, what do you got? Waste management, yeehaw, love it. Union, love it. Let's see here. Lockheed Martin, Honeywell, I love every single one of these companies. I think this is great. I wouldn't change a thing. 20 years, great companies. All industrials, good dividend. What's the performance? Like this is beating your overall slice. Like this is actually really good. I like that. Healthcare, Johnson & Johnson, AbbVie, Pfizer. I'm trying to think. Yeah, so here's the thing. I was thinking about maybe suggesting a few growth healthcare companies like Medtronic or BDX or Stryker, but you probably don't know those companies. And I would rather you invest into companies that you're familiar with than try to go and invest into companies that you may never have heard of. So I do like this. If you do want to do some research on some growth companies, check out those, Medtronic, BDX, and Stryker. Really great companies. Consumer discretionary. Oh man, I love this. I love it. Wouldn't change a thing. What was this? Utilities. VPU, love it. Duke, Southern Company. You could look at NextEra Energy. So here's the thing. With VPU, you're already getting NextEra Energy. Let's see here. Yep, NextEra Energy is the largest holding, as well as Duke. But I think it's a pretty high. This is a pretty high dividend yield. Maybe put this down to 4 or 5. You probably don't need 6% in utilities. The reason why you don't need it now, so you said your time horizon is 20 years. So everybody listen up. This is what I'm talking about, time horizon. You don't have to put your final allocation today if you know that your time horizon is in 20 years. You can always adjust this on an annual basis or every couple of years. Let's say you want to keep these companies for the next 20 years. Well, great. Why not lower the allocation today, invest more into growth, invest into these companies or these ETFs, which are growing faster, and then in 10 years or in 15 years, increase utilities, and you'll accomplish two things. One, you'll benefit from the growth of the other holdings. You'll also benefit from the reduced amount in taxes that you'll be paying for the next 20 years. Did you just get a light bulb? That's the light bulb, everybody. So you can keep these, but my recommendation would be, well, do you really need them at 6%? Put them at 3%, right? You still have them, you still own them, but you're not focusing on them yet. Okay? All right. So Diana, I love your portfolios. I think these are great. Those are just some pretty nitpicky things here that I was mentioning here. But overall, really like your Roth IRA, really like your standard portfolio. Thank you so much for sending over your portfolio. All right, the last portfolio is from David. He writes, "Hey Jake, I'm a huge fan. Even though I'm not a dividend investor, I try but prefer growth. I still love watching your videos and learning. I would really appreciate it if you could review my pie. A little bit about me. My name is David. I'm currently 36 years old, living on the East Coast. I've been investing for about 4 years now. Aggressively, I contribute $1,500 to $2,000 a week to my taxable account and $500 a month to my Roth IRA. My Roth only has one holding, which is VTI. VTI. I'm looking to retire early or at least semi-retire within 4 to 5 years. Hopefully, here's my pie. Any suggestions would be appreciated. Thanks for all the great videos and info, David. Well, David, thank you so much, man. I appreciate it. VTI is a great ETF. I mean, I kind of mentioned this earlier here in the last portfolio. You know, you could go 100% VOO or VTI, the S&P 500 or the total U.S. stock market. I think that's completely reasonable in a Roth IRA or in a taxable account. If you did that in your taxable account, then we're talking a little bit of a different version of FIRE. You know, it's not really focused necessarily on the dividend. But yeah, let's take a look at your portfolio. So it looks like you are up about 68%. You have 5 holdings in here. You have a decent dividend yield. So it's kind of similar to the S&P 500, what I can see here. Your core is at 50%, growth at 25, and your dividends at 25. So what do you got in your core here? Your core is VOO. I think that is the most reasonable core that any person could have, and it makes a lot of sense. I couldn't agree more. I mean, for most people, this is the most passive way to invest, and it's the benchmark, right? You always hear people, well, if you're not beating the S&P 500, what's the point? Well, yeah, make that your core. Completely fine. What do you got here? You got VGT and you got VUG. Yeah, these are also really, really good ETFs. Over the long term and decades, I think you're going to do very, very well. Now you have to remember from 2009 up until 2021, we were in a bull market. It's possible for the next, handful of years that we're going to reverse back to the mean and we're going to be more in, a conservative energy utility market where growth is compressed, multiples are compressed, and you see less growth in growth stocks. But over decades, I think you'll continue to see this rapid growth that we've seen. All right, cool. So yeah, I like these ETFs. I like VOO. I like the growth ETFs. What do you got in here? VYM and SEHD. I like these. I like these as well. If you wanted to, so I really like SEHD. If you wanted to skew more towards growth, you could even consider adding or replacing VYM with DGRO. Or you could actually even look at another one. So if you're a growth investor, let's do something together here. DGRW. There's 2 ETFs that I would recommend you take a look at. You mentioned that you're not a dividend investor. Well, okay, that's cool. You don't hurt my feelings. But let's take a look at a few things that I would recommend you take a look at. So the first one is DGRW. So you know how most ETFs or dividend ETFs, they're backward looking. They're looking at historical returns. What has a company paid in the past? DGRW from Wisdom Tree is the only ETF that I know of that's really high quality and a low expense ratio that looks forward looking. It looks for the potential of dividend growth. That's the kicker. All other ETFs look at historical performance. DGRW screens for potential future dividend growth. Okay, so it's kind of cool. And you can see the different types of companies that they have in here, right? Your Johnson & Johnson, Apple, Microsoft, Merck, Philip Morris, Coca-Cola, etc., right? So this is how this ETF is set up. It's much more skewed towards growth. But yes, you do have a higher expense ratio, but it's really, really cool. I don't invest into this ETF. This is something that I would maybe consider investing in for our little baby boy, Lucas, but I haven't done it yet. Another one that you can look at is DGRO. DGRO is really great. Very low expense ratio. It's from BlackRock here. It's focused on dividend growth. It follows the index, the Morningstar US Dividend Growth Index. I made an entire video on my channel, so if you want to take a look at it, I do an in-depth review of this ETF. But essentially, it's skewed more towards growth, but dividend growth. So that may be something that you're interested in if you really want to focus on the dividend. But however, you did mention in your email that you're looking to potentially live off of the dividend or, supplement your income with dividends in 4 to 5 years. If that's the case, VYM is definitely going to be the better choice for a shorter time horizon. The other two, DGRO and DGRW, those are for like 20-year time horizons. Okay, so you wouldn't want to overly skew into those unless you had a long-term time horizon. Okay, so David, thank you so much for sending over your portfolio. I hope that this was helpful. Thank you so much for watching, everybody. I hope that this was helpful. I hope that you learned something new. I absolutely love reading your emails. I love it when you send over your portfolios. It's such an inspiration for me to see how different people are in different situations. Right when I read earlier today that there was a dentist making over 400 grand a year, it didn't make me jealous one bit. It made me excited for the person. You know, he's 31 years old. I think it is so cool. I also read other emails where people are living practically in poverty, right? So many people are in so many different situations that I'm able to engage with here. And it's all possible here through this YouTube channel. I'm just really grateful for it. Thank you so much, everybody. And as I mentioned, we're going to be traveling here through Europe this week. And yeah, when you watch this video, I will probably be either eating a bratwurst or on the Autobahn, or I don't know, what are those other cliches in German? I don't know. Okay, cool. Alles Gute, Dankeschön und bis bald.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.